It all started with a simple mistake, a moment of embarrassment. In 1949, a man named Frank McNamara went to dinner. He was at a fancy restaurant in New York City. He had clients with him. The meal was a success. The conversation was good. But then the bill came. McNamara reached for his wallet. It was empty. He had forgotten his cash at home. This was a deeply embarrassing situation. He had to call his wife to bring him money. The experience stuck with him. He knew there had to be a better way, a way to pay without carrying wads of cash. This single, awkward evening sparked a revolution. Frank McNamara couldn't shake the idea. What if you could have a single card? A card that proved you were trustworthy. A card that let you pay later. He teamed up with his lawyer, Ralph Schneider. Together, they developed a concept. They called it the Diners Club. It was a club for men who dined out often. Members would get a small cardboard card. This card would be accepted at a select group of restaurants. It was a simple solution to a common problem, a solution born from a moment of public humiliation. They launched the Diners Club card in 1950. The concept was straightforward. Cardholders could charge their meals at participating restaurants. At the end of the month, they paid the full balance to Diners Club. The restaurants paid a small fee to Diners Club for the service. It was a brand new business model. At first, only a handful of McNamara's friends and 14 restaurants in New York were on board. But the idea was a powerful one. It offered convenience. It offered status. It was the very first step toward a cashless world, a world we are still building today. The idea caught on like wildfire. People loved the freedom it provided. No more worrying about having enough cash for a nice dinner. Within a year, the Diners Club had over 20,000 members. It was accepted at restaurants across the country. They called it the First Supper, that fateful dinner. It was more than just a meal. It was the beginning of a massive shift in how we think about money. It was the birth of consumer credit as we know it. A small cardboard rectangle that would soon conquer the globe. But this was only the beginning of the story. The success of the Diners Club did not go unnoticed. Banks saw a huge opportunity. They saw a way to make money from this new idea of paying later. In 1958, Bank of America decided to take a bold step. They wanted to create their own card. A card that could be used for more than just dining. A card for general-purpose spending. They launched a massive experiment in Fresno, California. They mailed 60,000 unsolicited pre-approved credit cards to residents. The card was called the Bank AmeriCard. It was a small piece of plastic with a credit limit. This event became known as the Fresno Drop. It was chaotic, and it was a financial mess at first. Fraud was widespread. Many people didn't understand how it worked. They spent money they didn't have. Delinquency rates were incredibly high. Bank of America lost millions of dollars. But they learned valuable lessons. They learned about credit risk. They learned about managing accounts. They refined the system. The Bank AmeriCard was a revolving credit card. Unlike the Diners Club card, you didn't have to pay the full balance each month. You could carry a balance, and you would pay interest on it. This was the key innovation. Other banks wanted in on the action, but they couldn't compete with Bank of America's growing network, so they formed their own association. In 1966, a group of banks created the Interbank Card Association, or ICA. They wanted to create a card that could rival the Bank AmeriCard. This new system would allow member banks to exchange information about transactions. It would create a unified network. Their product was initially called the Master Charge, the Interbank Card. It was a direct competitor. The plastic war had officially begun. This competition changed everything. Bank AmeriCard eventually licensed its system to other banks, becoming the Visa network we know today. MasterCharge evolved into MasterCard. These two giants battled for dominance. They signed up merchants, they signed up customers, they built global payment networks. The simple charge card for dinner was now a powerful financial tool. It was controlled by massive banking institutions. The age of plastic money had truly arrived, and it was poised to take over the American wallet completely. The 1970s and 1980s were the golden age of credit card marketing. The battle between Visa and MasterCard was fierce. They weren't just selling a payment method, they were selling a lifestyle. They were selling freedom, status, and convenience. Television commercials, magazine ads, and direct mail campaigns flooded American homes. The messaging was clear and persuasive. A credit card was your key to the good life. It was your ticket to travel, shopping, and experiences you might otherwise have to save for. The ads made having a credit card seem essential. The famous ad slogans from this era became part of our culture. "It's everywhere you want to be," Visa told us. They showed people using their cards on exotic vacations and for special purchases. MasterCard urged us to get a card for the things that money can't buy. These campaigns were incredibly effective. They shifted public perception. Credit cards were no longer just for emergencies or wealthy business travelers. They were for everyone, for everyday purchases, for groceries, for gas, for a trip to the mall. The marketing machine was working overtime. This marketing blitz had a profound impact on consumer behavior. It normalized the idea of borrowing for everyday life. Before this, debt was often seen as something to be avoided, a sign of financial trouble. But the ads reframed it. Using a credit card was smart, it was modern, it was convenient. This cultural shift led to a massive increase in consumer debt. People started carrying balances from month to month. The banks, of course, were happy to collect the interest. The convenience of plastic came with a hidden cost, a cost that many were only just beginning to understand. By the end of the 1980s, the credit card was king. It was no longer a novelty, it was a necessity. Millions of Americans had one or even several in their wallets. It changed the way stores operated. We accept Visa and MasterCard signs were everywhere. It changed how people budgeted and spent their money. The simple idea from that 1950s dinner party had completely reshaped the American economy. It created a culture of immediate gratification. But a new technological wave was on the horizon, one that would make credit cards even more powerful. The rise of the internet in the 1990s created a brand new world, a world of online shopping. Companies like Amazon and eBay emerged. They offered a vast marketplace, open 24/7 right from your home computer. But there was a problem. How do you pay for things online? You couldn't use cash, checks were too slow and impractical. The solution was already in everyone's wallet, the credit card. It was the perfect tool for e-commerce. All you needed was the 16-digit number, the expiration date, and the security code on the back. This synergy supercharged both industries. Credit cards became the engine of the digital economy. They made online transactions feel seamless and secure. Payment gateways were developed to process transactions instantly and safely. The convenience was undeniable. You could buy a book, a plane ticket, or a new television with just a few clicks. This cemented the credit card's dominance in a way no one could have predicted. It was no longer just for physical stores, it was the universal key to the entire digital marketplace. The power of plastic grew exponentially. But so did the risks of online fraud and overspending. Now we are in the next phase of this evolution. The physical card itself is starting to disappear. We have entered the age of digital wallets and contactless payments. Services like Apple Pay and Google Pay store your credit card information securely on your smartphone. You can pay by simply tapping your phone at a terminal. You don't even need to take your wallet out. This is the ultimate convenience. A transaction completed in seconds. The technology has made spending money easier and faster than ever before, almost frictionless. This frictionless future also includes new ways to borrow. Buy now, pay later. Services like Klarna and Afterpay have exploded in popularity. They allow you to split a purchase into several interest-free installments. It feels less like taking on debt and more like a simple payment plan, but these services are a new form of credit, and they carry their own risks. It's easy to lose track of multiple payment plans. The penalties for missing a payment can be steep. From a forgotten wallet at dinner to a simple tap of a phone, the story of credit continues. It offers incredible convenience, but the risk of the debt trap is always there, a silent partner in every transaction.